Climate risk. Can the banking industry prepare for the risk and regulation? I am delighted to welcome the panelists to the dais. Mr. Shaji KV, Chairman NABARD. Mr. Madhav Nair, Country Head and CEO, Bank of Bahrain and Kuwait. Mr. Sanjay Gurjar, Co-Head, Standard Chartered Bank. Dr. Uma Maheshwaram Rajshekhar, Advisor, CDRI. And our moderator for this session is Madam Neetu Chitkara, MD and Partner, BCG. May I request you, Madam, to initiate the discussion? Please, ma'am.
A very good afternoon to everyone present. We realize the post-lunch session is always a tricky one, but we hope that we have a very interesting topic as we discuss for the next 1 hour or so. The topic that we want to cover as part of this panel discussion is climate risk. Can the banking industry prepare for the risks and regulations? So I was told the first thing I should do is make sure that everyone is on the same page with respect to definition of climate risk. So we'll start right from ground zero. This is the RBI definition of climate risk. Some of you would already be familiar with that, but essentially it says potential risks that may arise from climate change, which I think most of us understand, or from efforts to mitigate climate change as well. And we'll delve a bit deeper into what some of these might encompass over time. But while we look at definitions, many times what we don't see is actually the impact of change. And I think many of this, some of the bankers in the room again may be aware, we have started to see many more instances of climate-related disruptions, whether you talk about floods, landslides, etc. We are also starting to see the impact of this, not just in hundreds, but now sometimes in thousands of crores, which is starting to pan out. So it's clearly a very important topic for the financial services community. While the previous page spoke about physical risk, there's another very important element to look at, which is transition risk. So here, this would mean changes either because of regulatory changes. Many of us are aware in terms of the carbon border tax, which would come in Europe and would impact a lot of exporters from India. It could also mean newer market dynamics, for instance, changing consumer preferences. It could also refer to changes in technology. For instance, we have started to see shifts towards EV, and what does that mean for, let's say, existing technology as well as suppliers? The key message in all of this being that the winners of today may not be the winners of tomorrow. And therefore, how do we as the banking sector plan for some of these risks? I want to actually take some of these examples to say, how do you then bring all of these risks? Because one thing that bankers really understand is credit appraisal. So how do you actually bring all of this in our own banking terminology? What we have started to see many banks globally already start to do, and some of the banks in India as well, is a full-fledged approach of integrating climate risk into their business. RBI has also been talking about it through their framework, and therefore this would involve starting right from climate scenarios, going into impact assessment, then seeing what are the results, and also building these into specific use cases. Let me take a real example of how we can break this down. So if I talk about physical risk, how can you break down the physical risk impact when you look at your particular assets that you've financed? This would be a function of three things. You can look at hazards, which is basically coming from climate risk models, which says that in the future, are we likely to see, what is the frequency that we are likely to see of various climate-related elements and where? The second talks about exposure, that what is your own assets and how do they map with respect to the hazards? And final and very interesting one is actually vulnerability. Because just to take an example, if I look at droughts in a certain part of the country, an irrigated farmer may be impacted very differently compared to a farmer which relies purely on rain. So the vulnerability is something which can also be controlled, and therefore that's where financing, as you'll start to see, also plays a role. Again, while this was a framework, we've also applied this in many countries in Europe and have also started to see this in India. So this is just taking an example. This is pure data that you can create outside in. We've taken an example of NTPC. And if you were to look at all their plants across India and then start to map what are the various hazards and what are the risk scores that you see for these plants, imagine that information can already start to help you as you start to think about risk assessments. Many of the large players with infrastructure have already started doing that, but I think the question is, how can we integrate this even more in our decision making? And while that was at a portfolio level, you could even go down to each and every plant and say, what is the vulnerability to specific hazards? The question now many of us might ask, and the governor also talked about this, and we also talked about it in the inaugural, that climate risks are real. Does that mean that, is it just about compliance costs increasing for the bank? And I did want to take a slightly contra view here. Because if you see on the left, this is a chart, I had been sitting with a CRO of a financial institution and we showed the chart on the left. It talks about basically flood risk scenario in a particular region. And when they looked at it and they said, as per this, we should not be doing any business in Bhavnagar at all. And actually the answer is different because I think banking is fundamentally the business of taking risk. It's also about thinking through risk in a portfolio manner, that just the way we create enterprise risk portfolios or we think about portfolio risk, we have to think about that even in case of climate risk. What percentage of my portfolio is today in region, let's say, which are prone to climate risk or flood risk, etc. And then what are the kind of opportunities that arise from it? This is something, again, where we are seeing banks across the world play a lot of roles. So if you do have a lot of portfolio of people, let's say, in a climate-prone area, can you actually educate the customers in that area to say, these are the risks that you're likely to face, and therefore these are the measures that you need to take to be able to make your business more resilient. And that's what we also talk about on the right-hand side in one of the BCG perspectives. You can also see this online on how climate risk can actually be made into an opportunity. So I would say this is just laying out the context of our discussion. Over the next 45 to 50 minutes, we'll delve with our very illustrious panel here, talking about what does this mean in terms of banks and financial institutions, what steps they have already taken or plan to take, and then also in this very illustrious gathering, what are the things that we can do as an industry? There are a lot of things where the industry has come together, whether it's doorstep banking or many other IBA-led initiatives. Are there areas where, for instance, a climate risk utility or certain things which can be done as an industry rather than an individual bank? So that would be the focus of the discussion, and I really look forward to deliberating with the panelists on that. So with that, I'll actually get some of the panelists to comment, on our key questions. Maybe let me start with you, Shaji sir, talking about how do you see, what are the imperatives that you see in the context of climate risk for the banking sector?
Yeah. So good afternoon to all of you. In terms of climate risk, first of all, what I understand is that right now, most of the India is yet to build, and we need to protect current income of the people over here. And that income itself is in risk because of the climate events. So as per the assessment, almost every day, last year, if you see, almost 320 days out of 365 days, there were climate events in one part of India or other. So that means almost on a daily manner, this is happening. So for the banks, first of all, they have already taken positions. There are assets which are based on some incomes, future cash flows and all. They would have considered and given loans, created assets. But those assets will be at risk, first of all. So then that means that the income of the people, if it is not protected, then there is a problem. So that means and at the industry level itself, banks should collaborate for assessing the risk. So once the existing risk, and there is a BCG study also that almost 55% of the banking assets are at risk because of the climate events. And then if you add the retail advances, it will be still higher. So so the protecting the current assets, first of all, they should take some steps, and then also integrate the climate risk management practices for creating further assets. So in that count, what I will just understand one more thing here is that all banks first should understand the risk, what it is, assess maybe how much it will affect, and then they have to align with maybe the national protocols, international protocols, some frameworks will be there. In the process of alignment, a lot of capacity building need to be done internally, and also they may have to discuss with their stakeholders, their borrowers, tell them about these things, because they may not be sensitive to these. They may feel that climate risk is something which has to be tackled by somebody else. So in that count, the climate risks need to be now incorporated into the traditional risk management models already the banks are having. And this should not be treated as a standalone activity. It need to be embedded in all the activities which, both internal and external activities, which banks and any institution undertake. So on that count, RBI has come out with a lot of frameworks. I think we need to, and a lot of things are in the draft form as well. So then there is a responsibility of banking institutions to understand how these regulatory frameworks are evolving. And then as they understand, then they may have to have disclosures also, both regulatory disclosures and also proactive disclosures, which may give them better rating. If they come out with more disclosures, I think they may have better rating. That also need to be there. And then they need to also devise products. Of course, you all aware that a lot of banks are come out with both liability products and asset products. But as I understand, I think banks should have products not specific to climate, but in all their products, the aspects related to climate also need to be there. If we take care of that, so first we need to, banks or any institution, first you need to understand, then assess the risk, and then align. This will be my initial remarks.
Very relevant. I think all of us can remember those 3 words and already start to apply it. I'm going to ask you, Mahesh, to step in here. Obviously, as CDRI, you have seen this across 40 plus countries. How have you seen, or what do you think should be the imperatives for banks?
So just to give a quick introduction, we are a coalition of member countries which work towards disaster resilience, especially across critical infrastructure. So in our recent study, what came out is that globally, close to $800 billion of assets are getting affected on an annual basis. This is based on a very traditional risk modeling approach, CAT modeling, through which you look at hazards, and then you also overlay some of the infrastructure, global infrastructure assets, and look at the probability of it getting damaged given a particular event intensity and a frequency. That said, in India, that number is close to $30 billion. And $30 billion of critical infrastructure are anyway getting lost on an annual basis in some form or the other, And this, we are not even looking at the cascading risk. If a bridge collapses, then the economy also gets affected because of, goods can't be transported, or the mobility gets affected, people can't go to work, and so on and so forth. So it's important for us at this moment to not even think about climate change, but this is risk as it stands today. And this number is likely to increase, close to $40 billion if we look at the 8.5, which is the worst case scenario, and it may come down to somewhere around $35 billion, which is a best case scenario. That is the most optimistic scenario of 2.6, RCP. So given this, it's important that irrespective of climate change, one need to start looking at what is happening when it comes to natural events and take precaution, not from risk as a something that would scare the investors or scare the banks, but more in terms of how can you take informed decisions well in advance? How can you be better prepared? How can you be, taking few proactive measures, adaptation measures, what we call it, like you inform your borrowers that, take some precautionary measures, changing a few design solutions, planning norms, or having some kind of a buffer mechanism to safeguard themselves. Or worst case, at least you will be mentally prepared that these assets are in a high risk-prone areas, and then you can be assured that some kind of an early warning system or an information can help guide in better management, operation and maintenance of those assets, especially when it comes to energy, transmissions, generations, and so on and so forth. Within CDRI, we are currently developed something called as GIRI, which is a global risk model, especially for these 8 critical infrastructure types. And this is an open source model which is currently available. So just going back to what Sir was mentioning, if anybody would like to take their asset and overlay and look at the kind of exposure which Neetu was talking about, you can do that using that particular platform. This platform is freely available, so if somebody doesn't need to get into the detailed modeling, at least as a first step towards understanding how your assets are placed, as of today, you can use that model to do that. You can also do some future projections and also loss estimations, looking at the vulnerability curves and also the, the infrastructure types and future probabilities of the event. Thank you.
Very helpful. Madhav, anything from you?
Yeah, thanks, Neetu. I think you started off by giving a presentation. I think it set the context, and with Shaji sir and Rajshekhar chipping in, I would say that we are a large country, a diverse country, and the fastest growing economy. So in order, and we also noticed that there are significant climate risks, which has been highlighted by Rajshekhar ji. I think the amounts are huge. Probably one single institution is not taking that hit. That's why we don't realize it at an institution level. Probably it gets mixed between the banking sector, insurance sector, and probably government. My take on this would be, to begin with, I think it is still important for us to sort of work with communities, work with industries, work with companies, and sort of, I can give my own example. I've been speaking to a lot of mid-tier corporates, and they still don't see any need to start looking at this direction. So they are waiting for something like a SEBI guidelines or RBI guidelines to come in to start working on this. So probably the need of the hour would be to have a taxonomy defined, and that which is, I think, a work in progress by the government of India. Frankly, I think everybody of us in this room need to be aware of the 2 risks which you said. One is the physical risk and the transition risk, and these are 2 slightly different. I think when you mapped out the NTPC part, I think not many of us, probably in the relationship side or the credit side, would have ever done that. And I think when you spoke about that, your discussions with the CRO, that itself shows that many of us have not embedded those physical risks into our, risk assessment. High time we should do that, because data points are available. Probably the data points are not available at one place, and that's something which we could speak of as we, during the program. That's something which we need to sort of work on. The other part is the transition risk. I think very clearly there are many sectors which we have identified, I think, as an industry, which needs to sort of embark on the carbon net zero transition. And they need a lot of support from the financial sector, the government, etc. So we'll have to work. So these are 2 different risks. Probably banks need to embed them into their risk management framework and take it forward. Thanks.
Makes sense. I think we're all starting to talk about how important it is. So I will also maybe get in on the second question, and maybe Sanjay, I can get you in here. And again, as a multinational bank, you're seeing this across geographies. How have you, or what steps have you already started to take as you think about embedding climate risk into your own bank?
Sure. Thanks, Neetu, and good afternoon to everyone. So at Standard Chartered Bank, clearly our sustainability agenda is a huge focus for the bank. And within that, climate risk is a very critical component of that. Now, for us, over the last 2 years, we've been kind of running the whole climate risk assessment very diligently. We have a threshold, of course, for the size of the client and the kind of exposure that we have, beyond which we do that on a mandatory basis. But today, as we stand, almost 90% of our corporate clients are covered under this. So this is a tool that we do at the time of credit appraisal. Now, what we use is a proprietary model. It's by Baringa. Simultaneously, we are also developing our own model, and that is pretty much how the banking world is going to evolve. You'll obviously start with certain models which are proprietary and then move into your own models. You've got to develop on your own basis. So that is something that we've deployed and running simultaneously. Now, what are the critical input for any of these kind of models is really what starts with a climate risk questionnaire. And that's where some of the problems, and we'll get into that as probably the third question that Neetu had raised. There are a lot of challenges there, right? Because a lot of the input into that questionnaire is partly from public sources. The other part is from client disclosures, whether on physical risk or on transaction risk. And that clearly there are challenges there. But we're getting better. A lot of the data actually lines up more on the transition risk part rather than the physical risk. Now, once that model actually throws out something, what are the kind of things that we get out from on the basis of the output coming from the model? So 2-3 things in particular. First is, of course, it helps us from a climate risk management perspective, both in terms of portfolio planning, portfolio modeling, and forecasting. So all of that clearly is a key objective of the exercise. The other is our net zero goals. Clearly this is a pathway to that. And the third, which is a very important piece, equally important piece, is relationship managers. It's a great tool for our RMs, relationship managers, and sustainability finance bankers for client engagement. Because this is kind of almost a segue and it dovetails into client engagement on terms of advisory, in terms of financing, and a slew of other things that we can do with the client. So that's I just wanted to give you a brief idea of what we are doing as a global bank within this space. Clearly, these models are evolving. There's a lot of, as I said, we'll talk about the data challenges. But as it is pretty much a unidirectional way forward on this. There's lots to do, a lot more to do. But I think banks are just getting better and better at this.
Very helpful, Sanjay. And I think also, I think you alluded to this, right? That how do you use the RMs or the advisory? This is actually, it goes back to the point which Mahesh was making, that it's not just about something to fear. One is how to manage, and perhaps the way you were talking about, also thinking of how it can be used to create new opportunities in some ways. I'll maybe get you in here, Mr. Shaji, because obviously, NABARD is very active in the climate space now. You're also working with multiple banks anyway in the refinance domain. How do you see, or what steps has NABARD taken as you look at climate and climate risk?
Yeah. So if you see the last two words of our bank, National Bank for Agriculture and Rural Development, that rural development is very important for the country as a whole. In fact, almost 60% of the population is there. And the institutions who are working there, barring maybe the branches of the larger institutions, they may not be able to appreciate the effect of climate, or rather the risks associated with that. So we have an onerous task. First of all, we need to sensitize ourselves, and we need to also collaborate with those who can imbibe, or rather who can transmit their knowledge to us. In that process, if you see NABARD's history, we have been associated with various international agencies, including Green Climate Fund, the Adaptation Fund, the UNFCCC. So we were the direct implementing agency or direct accessing entity for all these international agencies. And we are also working with ADB and all. So they give us cross-country experiences to us. And we actually we try to customize those experiences for the Indian scenario. So for India, actually, it's an amalgam of various countries. If you see, it's a large country. Almost all agroclimatic situations in the world is present here. So one-size-fits-all approach will not work. And then added to that, 60% of the population who are in rural, they are growing at a slower pace, maybe at 1/3 of what the other side of India is growing. There is a rural-urban divide which is palpable, and the divide is getting accentuated. So there is an enormous task cast upon NABARD. Understanding that, what we did was that internally we developed, or rather we set up a focused Department of Climate Action and Sustainability, drawing upon our experiences of these last, say, 20 years. In fact, the asset side of NABARD, if you see, whatever assets we have created will actually qualify for what we call now as green. The problem with us is that we have not appropriately classified, or proper taxonomy was not there. So we realized that, I think last year, and we came out with a green taxonomy for ourselves. And also, simultaneously, in the last World's Earth Day in April 2023, we came out with a climate strategy for NABARD. Actually, NABARD is having a market-making role also. So whatever we do is not for our institution. Actually, we do it for the sector. So in the climate strategy, what we decided is that some 4 pillars we have drawn. One is the green lending. So we will work for developing products within our organization, and also will work with rural financial institutions to develop products with, which will actually include the climate part also in all of those products. That is one pillar. The second pillar is that internally also we'll transform. The green transition we'll have to do. And we have a larger, third pillar is the market making role which we need to do. We work with institutions for capacity building, and we work with sensitizing, and also we provide them with some technology as well, and data and technology, some models. And then the last pillar will be that raising resources. So the resources part is which is the hardest part which I found, because market is always greedy. They will ask for market-related returns for whatever activity we do. Even if we classify properly and do all the homework with much efforts, we'll come out with the proper frameworks, and then come out with a sustainability bond or a green bond. And we are not adequately compensated for the efforts which we take. So that we saw in the first issuance of the social bond which I have done. Though there were a lot of interest, it was oversubscribed, but the coupon was actually the market linked only. We didn't get any greenium or any premium on the coupon. So, so that is one part. The resources part now, domestically, what we have decided is that, okay, even for the sovereign gold bond, sovereign green bond also, the government didn't get that. So they have to actually modify those things. So what we internally decided is that, see, anyway, market will ask for the market-related returns only for any resources which we are raising for our green activities. Rather, it's not for your information, NABARD is not supposed to generate profit also, only surpluses, which we need not pay dividends to our stakeholder, that is the government, which is we are 100% owned by government. So whatever surpluses we'll create funds for various activities. So what we have done is that we have set up a climate change fund within NABARD. This climate change fund will be utilized for developing capacities of the institutions. All institutions who are working in rural, because our larger mandate is rural, within that the climate we'll embed, and then the capacity building we'll do of sensitizing the people and also providing them sufficient tools for that. And along with that, we will also help them develop innovative products, because these are all a lot of transient risks which we are facing, and as it goes, we need to be very innovative. Otherwise, we will not be able to meet the challenges posed by the climate risk. So that part, that climate change fund, though the corpus is around 100 crores, we will, depending on the demand, we'll enlarge that corpus. And also, we are working with some international agencies to set up a carbon fund, because in the West, I think a lot of developments are happening in the carbon credit market and such other things. So we need to now leverage those developments, those appetite over there for India. For that, the carbon fund, we are working with the Food and Agriculture Organization for setting up that carbon fund in India. And then we also have some training institutes where we have set up a climate change establishment there. Along with that, we are working with 2 departments. One is the Ministry of Environment, Forest and Climate Change. In the last budget, there was an announcement regarding green taxonomy. So whatever experience we have in developing the national green taxonomy, we are sharing with them. And also through them, we are accessing funds from the Green Climate Fund. And then the Ministry of Agriculture, the voluntary carbon market framework we are developing for agriculture. And also we are passing on our learnings in climate change initiatives, in tribal development, in the watershed development, and such other initiatives. Those, whatever pilot work we have done. See, NABARD actually identify a problem, do a pilot, and then find out solutions, any risks involved, and then enlarge it as a national level program. You have found that in the SHG Bank Linkage program, in the FPO, the Farmer Producer Organization program, the KCC. So similarly, we are now working with several pilots across the country to develop proper climate framework, then proper tools and proper taxonomy and proper strategy for the institutions.
I would say that's actually a lot happening both in climate risk as well as climate overall. And probably I'll move to, the next question, because you did cover what the banks are doing or financial institutions are doing and also what's planned. What stops us? What are the challenges that are faced today? And maybe Mahesh, we'll start with you this time in terms of what are the biggest issues, again, you see multiple financial institutions that people face on the ground in terms of what we want to do versus what we are able to do today?
So, first of all, we should acknowledge that what we are talking about is a bit complex subject, right? So, a lot of people have different perceptions towards it, and there are different models, different approaches to addressing the problem at hand. The first step towards solving it is acknowledging that there is a problem, and how do we understand it much better to basically act upon it, so that whatever we do is in an informed manner or data-informed manner. Coming to that second point, data-informed manner, people always struggle with accessing the right data. Much of this information is currently available with the insurance agencies. They have been doing it for ages. But it's not available in the public domain for financial institutions or government agencies or regulators to access it, to take a call on how much of their assets are exposed. So in order to address that, that's why we came up with this global infrastructure risk model to make data open to public as a social good, so that they can start at least using it for initiating a debate. Whether right or wrong is a different thing. There may be a 10% variation. That's also, right now, people are using guesstimates. So how do we move from guesstimates to estimates, which can help us take a call, whatever that may be. I think everybody, when they are aware that there is a particular percentage of their assets are at risk, everybody will take right decision, whatever that may be. The second key thing is that we always wait for a mandate, we always wait for some regulatory organizations, a government organization, to enforce it upon us. I think that is a bigger challenge, while we don't wait for waterproofing our house, right? Government to mandate that every house should be waterproof. We do it ourselves because we are going to safeguard our own property and assets. I think that shift in mindset is going to help us move forward. And it is also an opportunity, looking at the other question which you asked, maybe the investors, maybe the people whom you are working with will look at you as leaders, will look at you that, whatever investment they are making is going to be safeguarded, so you may get more investors into your bank, so on and so forth. There could be a cascading benefit. We have not yet started scoping that very clearly, but I think rather than looking at risk as something as a negative element, the more you look at it as an opportunity, how you can take it and how you can safeguard your own assets, your own investments, I think it changes the debate.
If I could just add to what Mahesh spoke, and this is really based on our experience in terms of the challenges that we face in putting all this together, right? Broadly, there are two categories of challenges. One is related to data, the other is related to capacity building. From a data perspective, the issues are as follows. I mean, clearly the client disclosures itself, the quality of client disclosures, that is something that has to get better. The BRSR guidelines issued by SEBI recently, that is a good step forward, but obviously there's a way to go there. Second is standardization of metrics, right? There's a large corporate, small corporate, mid corporate, everybody kind of does their own disclosures, has got the metrics that they report, very, very different. So standardization becomes a big challenge for financial institutions when they're receiving this. The third is reliability. Even if you get the data, how reliable is it? Again, no real standards to kind of figure that out. The fourth, and this is very, very important, especially when you're building models, historical data, the complete lack of it, right? We don't have historical data because this hasn't been done. Now, obviously, you have to start somewhere, but that does become a big challenge when you're trying to build a model. And last but not the least is physical assets and the locations and the specific risks associated with that. Again, there's the the fidelity of data and what we have on that is very not of a great quality, including the locations itself of every single asset in a company, and then the climate risk associated with each of those. So all those are kind of on the first side, which is data. The other equally important piece is capacity building. And two broad areas there which need a lot of focus. One is skill sets, right? Skill sets to understand this, skill sets for reskilling, upskilling, across the board, across your organization, across regulators, across companies and financial institutions, all of them. That's clearly one piece. And the other is an awareness of the methodologies and techniques which are available. What's the standard of awareness? How do you kind of ensure that that happens at a broad level across the organization, whichever part of the ecosystem you are? So I think these are some challenges. All of them are significant challenges, all work in progress, but they do end up stalling the entire process of moving to a completely strong climate risk assessment ecosystem.
Absolutely, and I would almost say the second half of what you talked about, right, apart from data, it's almost like a huge change management exercise which needs to be thought of in itself. Madhav?
Yeah, Neetu, I completely agree with what Sanjay has said, and he's basically covered most of the challenges. But I would also add one more challenge is on the risk management framework itself. Global banks have something to rely upon because they've been doing a lot of work. I'm sure Sanjay's bank is doing, across geographies, they're doing a lot of work. And that might be true also for some of the larger Indian institutions like NABARD, State Bank of India, etc. But if you're coming down to the mid-tier banks and mid-tier financial institutions, I think there's a lot more to be done from a risk management framework, because the challenge is that there is no industry standard model on how to embed climate risk into your risk management framework. In terms of how to identify, measure, and monitor climate-related risks, both from the physical risk as well as the transition risk is just not available for us. So I think in order for an organization to begin with, I think that's the fundamental part of it. So maybe that's where when we talk about the opportunities, probably that's where an opportunity also would come in. And the last part on the capacity building, I think when RBI came out with their first draft guidelines, they had nominated Indian Banks Association to be doing the capacity building part. So that's something which, as Sanjay said, it's work in progress. What IBA has done is that IBA has partnered with various international known entities like GIZ, UNEP, FI, Climate Bond Initiative, Climate Policy Initiative, including BCG. So I think that's also what we did along with IIBF, which is Indian Institute of Banking and Finance. We designed seminars aimed at specific target audience. So we had one set of training programs for the board members, because it was very essential, because when a proposal reaches the board, they should be aware what they are actually approving. The second was for the senior management, which included the MD, CEO, and the risk management team. The risk management team was the third. And the last one was for the relationship team, because they are the first point of contact with the clients. So we had 4 specific training programs done. IIBF also has come out with 2 certification programs. One is on the foundation and the second is advanced. And this is again an ongoing area which IBA is working with partners in order to sort of work on the skill shortages, if any. Thanks.
No, here, one point, no, we are losing sight of one point. That is the unpredictableness and the extremeness of these events, the climate risk. We are talking about from the national perspective when we talk. So normally our risk management models and all will have a one-size-fits-all across the country approach and all. Whereas in the climate risk part, if you see that the unpredictability and that also geography sensitivity. As I said, agroclimatic zones are vast and we can't have a one-size-fits-all. Even if we know price, how we price, that also price this risk, because normally the probability of default or loss given default, but loss given default, most of the extreme events, it will be 100%. And probability of default, we can't predict. That is the predictability of this. So we need to have actually more granular models rather than countrywide models. So we need to now have, say, one model for the Western Ghats, which are already recognized as very highly sensitive but populated. And then, see, we never imagined that floods will come in Gujarat. So now that also is happening. So these things, no, that unpredictable nature, how we price this, all these things, no, we need to go more granular. For that, as told, data is very important. And then data exists now. Most of the data exists in silos. And we are not able to access the data at the appropriate time in the manner which we want. So we need to now collaborate. See, now we have digital public goods across. But then existing digital public goods also should incorporate now the climate-related data, rather than setting up an additional digital public good for the climate. Initially, we thought of that, but then we realized that just as in our processes, we need to embed climate. I think in our digital public goods, say for example, whatever payment infrastructure we have created, those things now need to now incorporate this data as well, which will be easier now, or rather it will be more useful also, more accessible also, and then we need to build on that. So I think here the collaboration is which is important. Just like climate is all-encompassing, the climate event is all-encompassing, it's not institution-specific. The climate event happens, only one institution will be affected. No, all the institutions there. So the need of the day is that to meet the challenges, I think collaboration needs to be there.
In fact, you have already, I think we start to move towards the last question, and I think it'll be good to get perspectives from across the group that we've kind of looked at what are the challenges. Are there areas in which we think, as Sir you said, in terms of collaboration across the industry, whether it's on capacity building or on data, I think will be good. Maybe we can start from here and move that side.
Thank you. I think that's a good start, collaboration, bringing people together to understand and also address this particular challenge. Within CDRI, we are in the process of developing a playbook exactly to address what Madhav and Sanjay were talking about, to build capacity. How can financial institutions go about doing this process or understanding this process so that they can take their own, steps, or they can prioritize which one they want to focus as they go about the entire analysis. This playbook, in addition to this playbook, we are also in the process of downscaling some of our models. Right now, we have a global model which is available. Of course, it is of a certain resolution, and going back to what Sir mentioned, it's important to understand it at a granular basis. Right now, we have things at a resolution which is close to 200 meters, 300 meters, but getting it at a finer scale, so that people within certain cities, people within districts can take informed decisions of the probability of an event happening and the frequency and intensity of hazards, so on and so forth. So the downscaling is an effort which is ongoing. We may come up with a GIRI 2.0 very soon. And we may also add a few features such as API and other things so that you don't need to know the details. You can just feed in your asset location and you can get a risk profile much easier. And then you can take a decision on what to do with that particular risk profile. So these are 2 or 3 things which CDRI is currently embarking on, and we look forward to the general support. And if anybody has any queries and want to know more about what we are doing, we would be glad to provide. And our mandate, one of our mandate is to provide training and capacity building also. So we'll be glad to do that. So I'll stop there. Thank you.
Maybe Sanjay, you want to come in and then we can.
Yeah, so clearly for the very reason that we discussed, the challenges that we spoke about, clearly there is a case for a climate risk utility. So similar to, say, what CIBIL is for financial data, we certainly could do with a climate risk utility, which is some sort of a common platform, for financial institutions, which provides relevant data for climate risk assessment. So what could the form of such a utility kind of take shape in? So first and foremost, the collation of data itself, which is a critical part of this piece, getting data from approved and trusted sources. So it could be like, physical asset location data based on GST data. It could be utility bills for energy, water data, etc. So that's one part of it. And all of that then becomes a central repository for institutions for estimating emission data, right? So that's the first aspect of it. Second piece is this same platform then can also provide heat maps, especially on the more susceptible, high risk, high extreme climate risk regions, which can then be, again used by the constituents and financial institutions. Thirdly, they could also partner with RBI for, the platform could also partner with RBI for coming up with some sort of a prescribed format. I was talking about the point of standardization and making it simpler for everybody. Maybe that could happen. That's an important step forward. And then, of course, using all of this to build a scenario assessment tool. That would be great. I mean, if a climate risk utility kind of provides all of this. Last but not the least, and this is very, very critical and goes back to the point I made about challenges, this platform could serve a very useful role for capacity building. So, in terms of the skill sets, in terms of knowledge, in terms of sharing, best global practices, so on and so forth, one conduit for all of this, with, this platform itself getting a lot of inputs from global banks, other banks, etc. That will be great. So that would be the broad contours of what we have in mind in terms of a climate risk utility. Just one last point on that. Is this happening globally? So one immediate example that comes to my mind is in Hong Kong. So the Hong Kong Monetary Authority is running a beta version of a physical risk assessment platform. Now this is focused and it's used by financial institutions, and is focused on physical climate risk on commercial and residential buildings in Hong Kong. So it's an interesting project in beta version right now, but it is pretty much a reflection of the way forward and how things may pan out in this space.
HKM has actually been very active. They've also gone ahead and looked at tokenization of real estate, etc. So I think it completely makes sense. Madhav?
So I agree with Sanjay on this part. So let's look at the background. How are we addressing this right now? It's through the regulatory interventions. So both RBI and SEBI have come out with the regulations, and they have also brought this into their oversight and reporting frameworks. That's what they are doing. Also, the Government of India has some part of the data initiatives they come out with, which is the National Action Plan on Climate Change, and there is also sectoral data. But I think what Sanjay is referring is that we don't have a central repository of all such data, and that's where I think climate risk utility would come in. So I was also doing a bit of study, and I realized that probably on the climate side, it's always the EU and UK which are slightly ahead of the curve. And we do notice that there are the climate risk utilities available there. So apart from the data piece which Sanjay mentioned, and the data analytics piece also, I think they also share risk frameworks through this tool. So which again helps all institutions have a standardized approach towards the climate risk. That's critical. Also another thought came in my mind. Apart from all this, probably what we should be looking at is probably have some kind of a SRO for this particular green financing stroke climate financing initiatives. I think we are expecting a bit too much from the government and the regulators. Probably some part of it can also be done on a self-regulation basis. So probably at some stage, there could be, and this is cutting across institutions. It need not be only banks. It can cut across institutions. We all come under one common framework of an SRO, which can sort of, there is always a thought that there could be some arbitrage game being played by someone. So that can be mitigated. Also some kind of a conduct and some practices which can be kept common among all the participants, which will be healthy for the industry in the long run. Thanks.
Two things you're told. One is that we are looking at the regulator and the government for compliance, or rather spoon feeding what we need to do. I think in this aspect, of course, regulator will be very proactive. In fact, the Indian regulator is more proactive than many other regulators in the world. But then regulator is trying to be ahead of the curve. But I feel that every institution should be ahead of the curve in terms of dealing with climate. Otherwise, climate will be ahead of all of us, and then we all will perish. So there is a need actually for us to be ahead of the curve. That is one thing. And the importance of data has already been told. In fact, as we deal with rural people, so my answer will be specific to the rural areas where 60% of the Indian population reside, where India's almost 100% of infrastructure is yet to be built. So urban infrastructure is almost parallel with whatever is we are seeing in the developed West. But in the rural space, when when the infrastructure is yet to be built, the climate resilience has to be factored in. That is what even all the government also has realized that. But there, data insufficiency is one issue because in data is practically non-existent. Even if it is existing, then it's not being accessible in the way in which we want. So there, what we are trying to do is that we are working with international agencies. We are trying to actually take the experiences elsewhere to here. There, we are partnered with UNDP for developing data in climate resilient agriculture. We call it as DCRA, Data in Climate Resilient Agriculture. So we have developed this framework and also working with state governments. Almost 7 state governments we have already worked, and then we have populated data into those frameworks. And you all may be aware of the AgriStack initiative. The AgriStack initiative is that digitizing most of the rural activities, mostly agricultural activities. There are 3 types of layers are there. The one is the farmer layer, which is already there, the KYC, the India stack is available. The crop layer, the kind of crops they are growing, that will be the another layer. And the land, the digitization of the ownership or the cultivation. So these 3 layers will give us wealth of data. And we can add climate resilience also into these aspects, especially on the crop and also on the land layer, where geotagging of the land, which will give us a lot of information on how and when this climate event materializes. Then if we have a geotagged land area parcel there, then we can pinpoint on which all persons are affected, which all types of crops are affected, which all activities are affected. So that, that database building is already there, and that will be a digital public good. And on that, various risk assessment models, innovations can happen, just like what we have done with the NPCI infrastructure, where private sector players have come in using the data. They have evolved models for them, and that too area-specific models. So unless, of course, RBI will be giving us frameworks, government also will give us, some directions. But I think we need to now fend for ourselves, and we need to realize that whatever data we are having, I think we should collaborate. And in this sense, only financial institutions, including the insurance sector. Insurance sector also is a major player, insurance, because they may provide some innovative products for also to, and they can also reinsure, across the world. So some risk, financial risk can be mitigated appropriately. Thank you.
Absolutely. And I would say a lot of interesting, I'll just do a quick summary and then maybe we can take one question. I think when we talked about imperatives that banks might look at, we saw that very interestingly that risks need to not just be feared, but actually to managed, and how they can be looked at opportunities. I think we talked about steps, how people have looked at external models, internal models, talked about challenges on the data side, also on the change management side. And I think on the industry level, while we talked about a lot of things to address this, I really like the quote at the end, which is that every institution must be ahead of climate, otherwise climate will be ahead of us. I think that's a very good note to end the panel. We'll just take one question, sir.
Hello, I wanted to ask Sanjay ji or Madhav, we all talked about this risk. After RBI is only now on the disclosure and assessment, but we have not got the guideline. But globally, or India also, now it is happening. A lot of such risks are already happening. The government is also facing the meeting the recovery and the damage for that. So whether the bank for physical risk and transition risk, or at least physical risk, are we to have a higher capital allocation and also have that factor, climate risk, in the ICAP exercise? Because you said that instead of regulator or Madhav saying we are to do ourselves, because that is going to be a big issue. In a way, sometimes such losses which is not taken care, it can come on heavily on the institution. So is there any global where they have already taken that into the capital allocation, as well as in the pricing, as well as in the internal ICAP exercise, the climate risk?
So not really, but as far as the pricing piece is concerned, and I think Mr. Shaji spoke about it earlier also, for these sustainability-linked kind of issuances, earlier there was some understanding or expectation from clients that we'll get a pricing risk, but honestly that's now pretty much behind us. It's really a diversification of resource pools, funding resource pools, because there are very, very specific funds, institutions looking at sustainability. So, that is really one big piece which will change the dynamics of this. So clients will not be doing for pricing, they'll be going for diversification. And of course, the fact that they are doing something on the sustainable side. As far as capital is concerned, no, not to my knowledge. No. Yeah, right now I think what's happening is really more around the models, getting our systems right, making our own individual internal kind of commitments and public commitments. That is what is happening.
Okay, now here, one point is that the capital is for unexpected loss. The climate is expected loss or unexpected loss. Once we classify, whether we have classified this as an expected loss, if that's the case, then capital will be prescribed. So right now it is classified as an unexpected loss. So for that, it's classified as an expected loss. If it is there, then climate or rather capital buffer need to be there. So right now, we can't quantify this. If at all it is there, then some extra buffer need to be built in. The ICAP exercise, I think, see, RBI has given only the framework. We can go beyond that framework also. So that way, proactively, we may have to now set aside, depending on our assessment or the past events. For that, of course, data need to be there. So that then it's a chicken or egg situation. Whether first of all we have to build data, then prove that it is an unexpected loss. Then we need to provide capital. Otherwise, we have to provide for provisions as it happens.
And just another point on that is, ultimately, we spoke about that, the whole climate risk assessment model is meant to come out with risks on that, right? So that is, there's an inherent, either onerous or not onerous aspect on what you're putting, because your risk parameters are going to go up or down based on what you assess. So there's already a pass-through there.
Yeah, and maybe just one last point I'll add, since you asked about globally. I think actually in Europe, where they came up with the guidelines much before us, many of the banks first just looked at this, that, we have to write English and give, even for the regulator. But I think the regulator came down very heavily, that you have to not just, pay lip service to this. This is important for you, for your own business. And I think that differentiation is very important, that this is not just about reporting, about banks themselves realizing that this is for us. So
one thing, policy, the transition risk we made. So we are telling about the climate-related transitions, but the important thing is that the policy itself is going to change. And it evolves. As it evolves, some policies, or based on some policies, we have created an asset, it may become obsolete. So in that case, that transition risk, whether we have factored in, we look at climate events for transition risk, but actually policy events also need to be factored in. So RBI can come out with some guidelines all of a sudden, and we have to now comply with that. So we need to prepare for that as well.
It's a very evolving field, so very important to keep the eye on the ball. On that, I know we've just finished time, but thank you everyone for being a very patient audience. So maybe I think the panelists will be available outside. We can take one? Okay, I think we'll wrap up at this. Thank you so much.
Thank you, all dignitaries. Ladies and gentlemen, we will take 5 minutes to reset the dais for the next session.